Hi everyone, so let me just introduce myself. So my name is Jessica and I'm a master's student at Monash University. I'm currently taking BEX5114 taught by Joe and Kim, which has honestly been such a fun and challenging unit. This video is my reflection on the VC game, a 2-week simulation that challenged us to think like both startup founders and investors. This is one of the most practical and eye-opening ways to learn how startups grow and how investors make decisions. Every move from raising capital to allocating funds had consequences. Every mistake taught us something new. As a founder, we raised funds by selling shares and investing in product capacity, R&D, and marketing to grow fast and win market shares. The goal was to end with the highest ownership value. Meanwhile, as a venture capitalist, we had to identify promising startups to maximize our returns. So, through both roles, I realized that entrepreneurship isn't just about having great ideas. It's about creating value through smart financial decision, operational efficiency, and trust. When I played as a VC, I learned that being a good investor isn't just about putting money in. It's about understanding how founders use the money. Are they really efficient with their resource? Are they balancing R&D and marketing wisely? Or how sustainable is their cash flow? You can only evaluate a startup properly if you understand its financial report by the balance sheet, income statement, and the cash flow. These documents reveal how a business really performs behind the scenes. One big takeaway from using the full ratchet clause is protected our valuation, but I also saw how strict deal terms can discourage founders. In reality, successful partnerships are built transparency, fairness, and shared goals, not just contracts. That experience changed my mindset. The best deals aren't purely financial, they're based on trust and mutual respect between investor and founders. Moving on, when I switched roles to become a startup, it felt like F1 racing. Every decision mattered, and the pace was extreme. The competition was intense. We treated the market like a race, constantly analyzing other teams' moves, tweaking our R&D and marketing budgets, and introducing a bit of changes so competitors could not easily guess our next step. That flexibility helped us to adapt to rapid market shifts. We also discovered that market capitalization was heavily influenced by quarterly revenue, not just cash in hand. It taught us that valuation is driven by momentum, by how consistently you build and sustain earnings. Later in the game, we shift our focus on R&D to capturing market shares, putting pressure on other startups to react. It felt incredibly realistic because that's exactly how startup operates in the real world, balancing long-term innovation with a short-term growth to shape perception and value. So, looking back, a few things worked really well for us. We were bold and adaptable, investing early in R&D to build long-term strength while staying flexible when market conditions shifted. Our financial result reflected that by the final quarter, our cash flow turned positive and revenue grew significantly as shown in our income statement. But we also made mistakes. We overspent on marketing, chasing quick market shares that end up reducing our profit margins. Another key lesson was the importance of reputation and trust. Some startups attracted their better investors simply because they have credibility early on. Overall, this run reminded me that every financial choice is strategically choice. How we allocate resources, whether to R&D, marketing, or operations, directly shapes valuation, ownership, and long-term sustainability. The VC game really brought the theories of startup finance and accounting to life. It showed how capital structure, valuation models, and cash flow management shape a company's success. Our balance sheet and cash flow statements showed that disciplined reinvest and liquidity control can transform early losses into sustained growth. It also highlighted the importance of leadership and collaboration, making fast data-driven decisions while making your team align under pressure. In the real world, this decision unfold over months or even years, not days. The simulation condensed that complexity, giving us realistic glimpse of how high-stakes financial decisions feel in actions. If I could play again, I'd design a more structured financial forecast, stimulate different funding scenarios, and focus earlier on building long-term investment relationships rather than chasing the fast growth. So, to wrap up, the VC game taught me that startup finance is really about balance. Here are my top 3 takeaways. First, every decision compounds, even small missteps can have a long-term effects. Second, adaptability wins. The teams that learn and pivot fastest survive. Third, finance tells a story. Behind every number is trust, reputation, and strategic intent. Overall, this experience changed the way I see entrepreneurship. It showed me that great founders don't judge just to dream big. They manage money wisely, build relationships, and make decisions that creates lasting value. So that's all from me. Thank you very much.